We're delighted to have with us once again Nate Donnay, Director of Dairy Market Insight at INTL FCStone Financial. We welcome you back, Nate. It's getting to be a habit, and we appreciate it.
Thank you for having me back.
Recently, we heard you, Nate, and several of your colleagues giving a rather thorough analysis of the COVID situation, its impacts, and the longer-term effects on the dairy markets. We don't have time in this little spot to get into all of that stuff, particularly the COVID situation in terms of how folks are going to come out of it. But I thought you had some very insightful comments about what you were seeing, you and your colleagues were seeing in North America and globally for future milk production and therefore some impacts on price. I wonder if you might share a little bit of those insights on the production and pricing side of things for us.
Sure, and it's a timely conversation. The USDA is going to release the May milk production report tomorrow afternoon, Thursday the 18th. And as with almost all the data that's coming out during this pandemic, there's a wide range of possible numbers that we could get from the USDA. The general expectation is that May milk production is going to be below year-ago levels. My official forecast is 0.3% below year-ago levels, but the rumors are more like 2% below year-ago levels because of the base over base programs that some cooperatives and milk buyers put into place for May and June and some into July. So we know U.S. milk production here short term is going to be pretty weak, and it won't be a big surprise if it's down 1%, which is a pretty big drop for U.S. production. But the issues that got us to that negative 1% are now gone. Some cooperatives have dropped their base over base programs altogether. The market has rallied significantly. We're talking about $20 plus Class 3 milk prices. The market is telling the farmers to produce more milk. So our expectation is that milk production growth will be weak for May. It's probably going to be pretty weak for June. July may be back above year-ago levels. And then August, September, probably back above year-ago levels. There is some question about how quickly U.S. farmers could ramp back up in response to these better milk prices. But historically, when it's been profitable, U.S. farmers have found a way to produce more milk. So short term, little tightness in the U.S., but the incentives from the market are to expand production. And really that's what we're seeing across all the major exporters right now. Farm gate margins in Europe look pretty good. Not as good as U.S. margins are going to be for the next couple of months, but they're not bad enough to cause a significant contraction in EU production. Europe was running on the dry side over the last 2 months or so, but now over the past 2 weeks, they've received quite a bit of rain and they're looking better. It's not back to 100% in terms of soil moisture, but it's timely rain and it's going to help pastures and help milk production for the next couple of months. And there's a similar story for New Zealand. They were dry, a drought in January, February. They've been receiving some rain since then. It's not fully replenished pasture or soil moisture levels, but they're doing okay. And with, with the GDT auction this week, the dairy prices at the auction would suggest a payout to their dairy farmers about $6.40 New Zealand dollars per kilogram milk solids, and their cost of production is right around $6. So it's at least the current signals from the market are for New Zealand farmers to boost production moving forward. So the supply outlook looks pretty decent. The market's telling farmers you need to produce more milk, or at least don't cut any more milk from current levels. So then it comes down to the demand side a bit in terms of your price expectations. Our general feeling is that consumers are doing pretty good right now with all of the stimulus from the government, the extra payments in the unemployment checks, all the different programs that various governments are running right now. When those programs run out, the consumer is going to be in a much weaker position. And if we're still looking at decent milk production growth, that probably argues for some weakness in dairy prices Q3 and Q4.
Well, that's not necessarily the news that we wanted to hear, but as you have spoken with us and others earlier, the roller coaster ride perhaps may continue.
Yeah.
As we kind of wind up here, would you think then it's a good time for producers to be thinking about if they're not doing some risk management, they really need to be thinking about that now?
Absolutely. I usually think about it in terms of margins between milk price and feed costs. And right now, when you're looking at $3.50 or less corn on the board, and you're looking at class 3 at $16 to $17 a hundredweight, it's a profitable margin. As we've seen over the last 3 months, there's potential for very large swings in prices, but when you see the market offering you profitable margins during one of the worst recessions in history, it's probably a good idea to get some of that coverage on, just in case prices turn out a lot weaker than we think.
Sure. Well, we appreciate you sharing your insights with us in this short video, and we thank you once again for joining us on DairyBusiness.com. We're speaking with Nate Donnay, the Director of Dairy Market Insight for INTL FCStone Financial. Nate, thanks for being with us, and stay safe.
Thank you.
And this is Joel Hastings for DairyBusiness.com.